Ever feel like your taxes are written in, like, a secret language? Like you need some kind of decoder ring just to figure out what's happening with your hard-earned money?
Oh, absolutely. You are definitely not alone there.
Phew.
But today, we're really going to try and cut through that jargon. We're diving deep into individual tax compliance, planning, basically helping you understand your taxes better.
Okay.
We've got a fantastic stack of info here. We're going to demystify everything from, stock options, which can be super confusing,
Mm-hmm.
all the way to how your health savings account, your HSA, can actually be a powerful tool, not just for health expenses, but for taxes too.
Right. So our mission in this deep dive is really to pull out the most important bits, those nuggets of knowledge from these sources, give you a shortcut to being well-informed,
Exactly.
maybe find some of those aha moments, things that could save you money or just make your financial life a bit simpler.
That's the goal.
We're going to break down these sometimes really complex ideas into understandable pieces. We'll go into detail, but hopefully in a way that's easy to follow.
Yeah, step
So you can walk away feeling, more confident about your money decisions. Sound good?
Sounds great. Let's jump in.
Okay, first big topic. Let's unpack this idea of equity compensation awards. You hear about this a lot, right? Companies offering stock options, restricted stock.
More.
But what are they exactly? And crucially, how do they impact your taxes? Because this feels like one area where things can get really tricky fast.
You totally hit the nail on the head there. Understanding equity compensation, yeah, it can be complex, but it's so important because it's a huge part of how people are paid now.
Right.
Basically, it's your employer giving you a piece of the company. Could be actual shares, could be the right to buy shares later, or maybe even just a cash payout tied to how the stock does.
Okay.
The critical thing, the absolute key, is that how and when you get taxed really, really depends on the type of award you get. And to get a handle on that, you need to know a few key dates. These dates are everything.
Okay, so what are these crucial dates we need to track? And which one tends to trip people up the most?
Great question. So first, there's the grant date. Simple enough, that's just when they officially give you the award.
Got it.
Then, maybe the most important one for taxes is the vesting date. That's when any restrictions disappear and you actually gain the right to exercise the option or sell the stock.
Okay, vesting date. Big one.
Huge one. Then you have the exercise date. That's specifically when you choose to buy the stock if it's an auction, or cash out something called a stock appreciation, right, or SAR.
Right.
After that comes the sale date. Pretty obvious when you sell the stock you got. And finally, there's an expiration date. If you don't act by then, your rights just poof, disappear.
Wow.
And yeah, each of these dates can trigger different tax events. And like you hinted, often it's that vesting date or sometimes even the grant date that creates taxable income before you even see any cash.
Okay, let's start with the first type then. Non-statutory stock options, sometimes called non-qualified options, right?
Correct. NSOs or NQSOs.
When do these actually get taxed? Is there a main takeaway here that surprises people?
Yeah, with NSOs, it basically boils down to one question. Does the option have a readily determinable value, or RDV, when it's granted?
Readily determinable value. Okay, what does that mean in plain English?
It usually means the option itself is actively traded on an established market, like an exchange, or it meets a few other strict criteria. It's transferable, immediately exercisable, no major restrictions, and you can figure out its fair value easily.
Okay. And if it does have this RDV, which sounds maybe less common?
Right, less common for typical employee options. But if it does have RDV, then boom, you recognize ordinary compensation income right there in the year it's granted.
Wow, okay. Income right away.
Yeah, the amount is the fair market value of the option itself, minus anything you paid for it. And because you paid tax up front, there's no further regular tax when you exercise it later. Your basis in the stock then becomes the exercise price plus that income you already recognized. And your holding period for capital gains starts when you exercise. If you let these options expire, you might get a capital loss based on that value you were taxed on.
So if it does have that RDV, you're essentially paying tax up front on something you haven't really turned into cash yet. That sounds like a big cash flow thing to plan for.
Exactly. That's a huge consideration. It catches people off guard.
Yeah.
But what if it doesn't have this readily determinable value,
Right.
which you said is more common?
Right, much more common, especially for private companies or typical employee grants. In that scenario, the taxable event shifts. It moves to the exercise date.
Ah, okay. So not a grant, but when you actually buy the shares.
Precisely. On the day you exercise, you recognize ordinary compensation income. The amount is equal to what's called the bargain element.
bargain element.
Yeah, think of it as your immediate paper profit. It's simply the difference between the stock's fair market value on the day you exercise and the lower price you paid to exercise the option.
Gotcha. The discount you got. Exactly. That difference is ordinary income to you in that year. Your basis in the stock then becomes that fair market value on the exercise date. And your holding period for capital gains also starts on that exercise date.
Okay.
And if these lapse without you exercising, you can generally deduct a capital loss equal to whatever you paid for the options, if anything. Usually that's zero, so often no loss.
This is still feeling a little theoretical. Can we walk through a real-world example? Let's use Bob.
Absolutely. Examples make it much clearer. Okay, let's take Bob.
Yeah.
On July 1st, year 10, he gets an NSO to buy 200 shares of his company's stock at $12 a share.
Okay.
Now, crucially, let's say this specific option is traded on an exchange, and it's selling for $4 per option on that grant date. So it has that readily determinable value.
Right, the less common case, but good to see.
Exactly. So in year 10, the grant year,
Hmm.
Bob has to recognize $800 of ordinary compensation income. That's the $4 option value times 200 shares. He reports this, pays tax on it, even though he hasn't bought the shares yet.
Okay, tax it year one.
Now, fast forward, August 7th, year 11. Bob exercises the options. The stock itself is now trading at $18 a share. But remember, because the option had RDV at grant.
Oh, no tax now.
Correct. No regular tax consequence on the exercise date. His adjusted basis in the stock he just bought is $3,200. That's the $2,400 he paid to exercise, 12 by $200 shares, plus the $800 of income he already recognized back in year 10.
Makes sense. Here to pay tax on part of it.
Exactly. Then, November 1st, year 12, Bob sells all 200 shares for $20 each. That's $4,000 total. His basis was $3,200.
So $800 gain.
Right. And because his holding period started back on the exercise date in year 11 and it's now year 12, it's been over a year. So that $800 is a long-term capital gain.
Okay. So the big takeaway for Bob and for everyone listening is if your NSO has that RDV, you take the tax hit upfront at grant. That might mean paying tax before you have cash.
Precisely. Big cash flow point. But the upside, if you can call it that, is any growth after that initial option value is taxed later, potentially at lower capital gains rates when you sell the stock.
Okay, got it. Now let's shift gears to statutory stock options. You hear these are generally more tax favorable. What makes them different? Why would a company offer these instead?
Right. Statutory options are different. They fall into two main categories. Incentive stock options, usually called ISOs,
ISOs, heard of those?
and employee stock purchase plans, or ESPPs. Congress created these specifically to have better tax treatment than NSOs. The idea is to encourage employees to own stock, align their interests with the company.
Okay, more favorable. How to?
Well, they come with a bunch of specific IRS rules you have to follow.
Yeah.
But if you do, the tax benefits can be pretty significant.
Let's break them down. What about ISOs?
Okay, incentive stock options, ISOs. They have to be part of a written plan, approved by shareholders. You generally can't own like more than 10% of the company. You have to stay employed until pretty close to when you exercise, usually within 3 months.
Mm-hmm.
A key rule: the exercise price can't be less than the stock's fair market value on the grant date, so no discount at grant. But the most crucial part for you, the employee, is the holding period rule. To get the best tax treatment, you must hold the stock for at least 2 years after the grant date and at least 1 year after the exercise date. People call this the 2-1 rule.
2 years from grant, 1 year from exercise. Okay, that's critical.
Absolutely critical. If you mess that up,
Mm-hmm.
the tax benefits change dramatically.
Yeah.
Oh, and there's an annual limit. You can only exercise $100,000 worth of ISOs based on grant date value per year. Anything over that gets treated like an NSO.
Got it. What about the other type, ESPPs?
Employee stock purchase plans. These are usually broader programs offered to most full-time employees. Again, written plan, shareholder approved.
Okay.
A big difference here. The exercise price can be less than the fair market value. Often it's set at 85% of the FMV on either the grant date or the exercise date, whichever is lower. So you get a built-in discount.
Nice. 15% off, potentially.
Exactly. Like ISOs, though, to get the best tax treatment, you generally need to meet that same holding period. Hold the stock at least 2 years after grant and 1 year after exercise. And you need to stay employed.
So what does this all mean for taxes then? Why are they called more tax favorable? What's the payoff for following all these rules?
Okay, here's the main reason. Generally, with statutory options, there's no tax recognized as compensation when the option is granted, or even when you exercise it.
Wow, okay. No tax at grant or our exercise.
For regular tax purposes, generally no. Your basis in the stock is just what you paid for at the exercise price, plus anything you paid for the option itself, if applicable.
So where's the tax?
The tax event happens when you sell the stock. And here's the magic. If you met that crucial 2-1 rule holding period,
2 years from grant, 1 year from exercise.
right, if you meet that, then your entire gain or loss when you sell is treated as a capital gain or loss, usually long-term capital gain.
Ah, and capital gains rates are usually lower than ordinary income rates.
Much lower, potentially. That's the huge advantage, turning potential ordinary income into lower taxed capital gains.
Okay, sounds great. But you mentioned catches earlier, especially with ISOs.
Yes, there are definitely catches. First, if you don't meet that 2-1 holding period rule, say you sell the stock too soon, it's called a disqualifying disposition.
Okay.
In that case, part of your gain gets recharacterized. The bargain element, remember that difference between the stock's value at exercise and your exercise price. That part becomes ordinary income. Any gain above that is capital gain. Any loss is capital loss. So selling too early really hurts the tax benefit.
Right. Lose the capital gain treatment on that initial spread.
Exactly. And the other big catch, specifically for ISOs, is the alternative minimum tax, the AMT.
Ah, yes, the AMT.
Even though you don't pay regular income tax when you exercise an ISO, that bargain element, the FMV, at exercise minus the exercise price, is considered an AMT preference item, meaning it gets added back to your income when calculating the AMT.
Yeah.
So exercising ISOs, even if you don't sell them right away, could potentially trigger the AMT for you in that year, creating a tax liability you might not have expected.
Oof. So even if you hold for the long term, you might have an AMT issue in the year you exercise.
Precisely. It's a major planning point for anyone with ISOs.
Okay, let's make this concrete again. Let's bring Mary into it, focusing on that AMT piece.
Perfect. Well, let's look at Mary. July 1st, year 10, she gets an ISO to buy 200 shares at $120 per share. That was the fair market value at grant, so it qualifies.
Okay.
She exercises on August 7th, year 11. The stock is now selling for $150 a share. Now, for her regular income tax, Mary recognizes zero ordinary income. Nothing at grant, nothing at exercise. It's an ISO.
Good so far.
Her basis in those 200 shares is simply what she paid, $24,000, 120 times 200.
Okay.
But now, the AMT. In year 11, the year she exercised, Mary has an AMT preference item.
Mm-hmm.
The difference between the $150 FMV at exercise and our $120 purchase price is $30 per share.
Right.
Multiply that by 200 shares, and you get $6,000. That $6,000 gets added back to her income just for the AMT calculation in year 11. It might or might not cause her to actually pay AMT, depending on her other income and deductions, but it's definitely counted.
That's a potential hidden tax. Okay, what happens when she sells?
Let's say November 1st, year 12. She sells all the shares for $200 each. That's $40,000 total. Her basis was $24,000. And crucially, she did meet the 2-1 holding period rule. Granted year 10, exercised year 11, sold late year 12.
So capital gain?
Yes, a long-term capital gain of $16,000, $40,000 minus $24,000. So the ISO worked as intended for regular tax, nice long-term capital gain treatment. But you cannot forget that potential AMT hit in the year of exercise.
Definitely key planning point. Okay, moving from options to actual shares now, restricted stock. What's the main difference here? And tell me more about this 30-day election thing that sounds important.
Right. With restricted stock, you're actually granted shares of stock, not just an option. But they come with restrictions usually. You can't sell or transfer them until they vest on a certain date or after a certain period.
Okay, so you own them, but sort of conditionally.
Sort of, yeah. For tax purposes, the general rule is you recognize ordinary compensation income equal to the fair market value of a stock on the day it vests.
Ah, the vesting date again?
Yes. Whatever the stock is worth when those restrictions disappear, that's your income. Your basis in the stock becomes that same fair market value on the vesting date, and your holding period for capital gains also starts on the vesting date.
Okay, seems straightforward enough. But the election.
Ah, the election. This is under Section 83B
Yeah.
of the tax code. It allows an employee to make a choice, an irrevocable choice within 30 days of the grant date,
30 days, okay.
to recognize the ordinary income then, based on the stock's value at grant, instead of waiting until it vests.
Why would you do that? Pay tax sooner.
It sounds counterintuitive, right? But imagine you get restricted stock when the company is young, maybe the stock price is really low, like $1 a share.
Yeah.
You expect the company to do really well, and by the time it vests in 3 years, maybe the stock will be $20 a share.
Okay.
If you don't make the 83B election, You'll pay ordinary income tax on $20 per share when it vests.
Mhm.
But if you do make the election within 30 days of grant, you pay ordinary income tax on just $1 per share now.
And then...
And then all the future appreciation, that $19 difference, gets treated as capital gain when you eventually sell the stock, assuming you hold it long enough after vesting. You convert future ordinary income into capital gain.
That sounds potentially huge, especially if the stock really takes off.
It can be huge, but there's a risk.
What's the risk? Sounds like a no-brainer if you're optimistic.
The risk is if you make the election, pay the tax upfront on the grant date value, and then the stock goes down. Or maybe you leave the company before vesting and forfeit the stock entirely. Yeah, that 83B election is irrevocable. You don't get that tax back. You paid tax on value you never fully realized or maybe never got at all.
So it's a gamble on the future stock price and your continued employment.
Exactly. High potential reward, but real risk. You need to weigh that carefully.
Okay. What about restricted stock units, RSUs? Are they the same? Can you make that election?
Good question.
Mm-hmm.
RSUs are a bit different. They are actual shares of stock when granted. They're more like a promise from the company to give you shares on the vesting date.
Okay. A promise of shares.
Right. And like restricted stock, if you don't make the election, you recognize ordinary compensation income based on the fair market value of the stock on the vesting date.
So far, similar.
But here's the crucial difference. With RSUs, there is no 83B election. You cannot choose to recognize income at grant. You always recognize ordinary income when they vest based on the value at that time, period.
Okay. No election gamble with RSUs. Simpler, maybe, but potentially less tax efficient if the stock skyrockets.
Exactly. Less flexibility, less risk perhaps, but you lose that potential upside of converting future appreciation to capital gains.
Let's see how this plays out for Agnes, assuming she has restricted stock and doesn't make the election.
Okay, Agnes, July 1st, year 10, she gets 200 shares of restricted stock.
Yeah.
FMV at grant is $100 per share. She does not make the 83B election within 30 days.
So, year 10 tax impact.
0. No taxable income related to this grant in year 10.
Okay.
The stock vests on August 7th, year 11. On that day, the stock is trading at $110 per share.
So now she has income.
Yes. On this vesting date, Agnes recognizes ordinary compensation income of $22,000. That's the $110 FMV times 200 shares.
Got it. Ordinary income.
Her basis in the stock also becomes $22,000, and her holding period starts now on the vesting date. Then, November 1st, year 12, she sells the stock for $125 a share, getting $25,000.
Okay. Basis, $22,000 sold for $25,000.
Right, so she has a $3,000 gain, and because her holding period started in year 11 and she sold in late year 12, it's a long-term capital gain.
Perfect. Shows how that vesting date is the key trigger without the election.
Precisely.
And finally, for equity comp, what about stock appreciation rights, or SARs? What's the main thing to know there? Are these common?
SARs are maybe a bit less common than options or RSUs, but you do see them. The key thing with SARs is that employees don't actually get shares of stock, ever.
No shares. Okay, so what do you get?
When you exercise a SAR, you simply receive a cash payment from the company.
Cash. How much?
The cash amount is equal to the appreciation in the stock's value. Specifically, the difference between the fair market value on the day you exercise and the fair market value back on the day the SAR was granted.
So you get the gain in cash.
Exactly. And because it's cash received as compensation, that cash payment is simply recognized as ordinary compensation income when you exercise the SAR.
Simple enough. No stock bases, no capital gains worries, just ordinary income when you get the cash.
That's right. Much simpler from a tax perspective, but again, it's all ordinary income, no chance for capital gains treatment.
Wow, okay. Equity comp is definitely, like you said, complex, but super important to understand. It really shows how timing and the specific type of award matters so much.
Absolutely.
And speaking of unexpected tax stuff, our next couple of topics might really surprise people. We're talking taxes popping up where you might least expect them, like just lending money to a friend or working overseas.
Yeah, these are areas that often fly under the radar but can have real tax implications. Let's start with imputed interest on below-market loans.
Imputed interest. Sounds ominous. What's that about?
It is a bit strange sounding.
Yeah.
Basically, if you lend money to someone, could be a friend, family member, employee, shareholder, at an interest rate that's lower than the official rate set by the IRS.
Okay, like a zero-interest loan to your kid, maybe?
Exactly like that. Or just a very low rate. The IRS can step in and say, hey, you should have charged more interest. They calculate this foregone interest, the difference between what the interest should have been using their rate, called the applicable federal rate, or AFR, and the interest that was actually paid.
And then what?
And then the lender generally has to report that foregone interest as interest income on their tax return, even if they never actually received it in cash,
Wow. So you pay tax on money you didn't even get.
pretty much. The IRS imputes the income to you. The borrower, depending on the situation, might be able to deduct that imputed interest, but the lender definitely has income.
What kinds of loans does this apply to? Just family stuff?
It covers several types. Gift loans, like between family and friends, compensation-related loans, like an employer giving an interest-free loan to an employee, corporation shareholder loans, and basically any loan where a main purpose is just tax avoidance. Also some specific loans to continuing care facilities.
Okay, I can definitely see this happening. Can you give us a quick example, Pat and Robert?
Sure. Let's say Robert lends his friend Pat $20,000. He only charges 1% annual interest. But the IRS's applicable federal rate, the AFR, for that type of loan is currently 3%.
Okay.
So the interest based on the AFR would be $600, $20,000 by 3%. But Pat is only paying $220,000 by 1%.
Right. Difference of $400.
Exactly. That $400 is the foregone interest. Robert, the lender, has to report that $400 as imputed interest income, in addition to the $200 he actually received. So he reports $600 total interest income.
Even though he only got $200 cash. Okay, that's a potential trap. Are there ways around this? Exceptions?
Yes. Thankfully, there are some important exceptions. The biggest one is a de minimis exception. Generally, if the total outstanding loans between the borrower and lender are $10,000 or less, these imputed interest rules don't apply.
Ah, okay, so small loans are usually fine.
Usually. For gift loans under $10, the exception applies as long as the loan isn't used to buy income-producing assets. For compensation or corporate loans under $10, it applies if tax avoidance wasn't a main goal.
Good to know. Any other exceptions?
Yeah, there are others. Things like government-subsidized student loans, normal business loans like 0% car financing from a dealer, regular credit card terms, certain loans for employee relocation, some loans involving foreign persons, and certain gift loans to charities up to $250K. And there's a special, helpful rule for gift loans of $100,000 or less between individuals.
No.
For these loans, the amount of foregone interest the lender has to report is limited. It can't be more than the borrower's net investment income for the year.
Net investment income.
Like dividends, interest.
Exactly. And if the borrower's net investment income is $1,000 or less for the year, the lender reports zero foregone interest.
That's a big help for, say, parents lending money to kids for a down payment if the kids don't have much investment income.
Precisely. As long as tax avoidance wasn't the main point of the loan, it takes the sting out of many common family loan situations.
Okay, that's really useful. Now, what about working abroad? You mentioned potential tax benefits there. It seems like earning income outside the U.S. would just make taxes more complicated.
It can add complexity, definitely. But there's a potentially huge tax break available, the foreign earned income exclusion.
Exclusion, meaning you just don't pay U.S. tax on it. Up to a certain limit, yes. U.S. citizens and resident aliens who work abroad might be able to exclude a significant amount of their income earned from foreign sources from their U.S. gross income.
How significant?
For 2023, the maximum exclusion was $120,000 per qualifying person.
Wow, $120,000 excluded. That's huge.
It's massive. Think about the tax savings. If you're in the 24% bracket, that's $28,800 less tax. If you're in the 37% bracket, it's over $44,000 in tax savings.
Incredible. What counts as foreign earned income? Just salary.
It's pretty broad. Salaries, wages, bonuses, commissions, professional fees, tips, basically income received for services you perform while physically in a foreign country.
Okay, so how do you qualify? Do you just have to live overseas?
You have to meet specific tests. There are two main ways to qualify. The first is the bona fide residence test. This means you have to establish that you are a legitimate resident of a foreign country for an uninterrupted period that includes one entire tax year. It's about facts and circumstances, where's your home, family, social ties, etc.
Okay, sounds a bit subjective. What's the other test?
The other one is often easier to meet and more objective. The physical presence test.
Physical presence.
Yeah, this just requires you to be physically present in a foreign country or countries for at least 330 full days during any 12 consecutive month period.
330 days out of 365, essentially.
Exactly. And those 330 days don't even need to be all in a row. You could bounce around different countries, take short trips back to the U.S. As long as you rack up 330 full days physically outside the U.S. within a 12-month window, you can qualify.
That seems much more straightforward. Let's check on Thomas. Did he meet the test?
Okay, Thomas Peters, U.S. citizen, moved to Israel 12 months ago for work. In that 12-month period, he only came back to the U.S. once for a 2-week visit to Idaho.
So 14 days in the U.S.
Right. The 12-month period has 365 days. So track those 14 days he was in the U.S. That means he was physically present in a foreign country for 351 days. 365, 14.
351. That's more than 330.
It is. So yes, Thomas qualifies under the physical presence test. He can exclude his foreign earned income up to that $120,000 limit for 2023 from his U.S. income tax return. Huge benefit.
Fantastic for Thomas. Okay, let's switch gears again. Let's talk strategy. You hear about timing, right? Like when you get income or when you take a deduction can actually change how much tax you pay. How does that work? What's the art of timing?
Timing is incredibly powerful. It's one of the fundamental tax planning strategies. The core idea, assuming your tax rate stays the same year to year, is pretty simple.
Okay.
You want to defer taxable income into a later year, and you want to accelerate tax deductions into the current year.
Defer income, accelerate deductions. Why?
It all comes down to the time value of money. A dollar today is worth more than a dollar tomorrow, right?
Right. Inflation and investment opportunity.
Exactly. So
Yeah.
if you can delay paying a dollar of tax until next year, that dollar is worth less to the government, and you get to hold on to your money longer. Similarly, if you can get a dollar tax saving from a deduction this year instead of next year, that saving is worth more to you now.
Makes sense. Delay the pain, speed up the game.
That's a great way to put it. But, and this is a big but, that assumes your tax rates are constant.
Which they often aren't, right? Tax laws change, our income changes.
Precisely. The tax environment is dynamic.
Right.
Your personal tax rate might go up or down. Your situation might change. Maybe you retire, start a business, get married, have kids. The type of income matters. All these things can affect whether deferring income or accelerating deductions is actually the best move.
Okay, so the basic rule is a starting point, but you got to look closer.
You absolutely have to look at your specific situation. Let's use Jill's business again to see this in action. First, let's assume constant tax rates.
Okay, Jill's back.
Jill, a cash-basis business owner, has a $100,000 sale she can finalize. She can get paid December 31st this year, or wait one day and get paid January 1st next year. Her marginal tax rate is 32% in both years. Assume she can earn 10% after tax on her money.
Okay. Income this year or next year?
If she takes it this year, option A, she pays $32,000 in tax right away. Net cash this year is $68,000. If she defers it to next year, option B, she still pays $32,000 in tax, but she pays it a year later.
So time value of money helps.
Yes. That $32,000 tax payment next year only has a present value of $29,088 today, discounting at 10%. So her net result from option B in today's dollars is $70,912 on $100,000 income minus $29,088 present value of tax.
So deferring is better by about $2,900.
Exactly. When rates are constant, deferring income is generally better because you delay the tax payment.
Okay, that makes perfect sense. But you mentioned the caveat, what if tax rates aren't constant? That feels more realistic for a lot of people.
It often is. So let's tweak Jill's situation. Same $100,000 sale, December 31st or January 1st. But now her tax rate is 32% this year, and she expects it to jump to 35% next year.
Okay. Higher rate next year. Does deferring still make sense?
Let's see. Option A, income this year. Taxes $32,000, 32% of $100K. Option B, income next year. Taxes $35,000, 35% of $100K.
So the tax bill itself is higher if she defers.
It is. But we still need to consider the time value of money. That $35,000 tax payment next year has a present value today of $31,815, discounting at 10%.
Okay, $31,815 present value tax if deferred versus $32,000 tax paid immediately if taken this year.
Right. So deferring is still slightly better by about $185 in after-tax income. 100K, 31,815 versus 100 to 32K. But the benefit is dramatically reduced because of that higher tax rate next year.
Wow. So a rate increase really eats into the benefit of deferral. It might even flip it if the rate jump is big enough.
Absolutely. It shows you really have to crunch the numbers based on your expected future rates.
Okay, how does this apply to deductions? Is it just the opposite logic? Speed them up?
Exactly. With deductions, the general rule, constant rates, is accelerate them to get the tax savings sooner. Let's say Jill needs to buy $20,000 of equipment. She can buy it and deduct it this year or wait until next year. Her rate is a constant 32%.
Okay, buy now or buy later.
If she buys this year, option A, she gets a $20,000 deduction, saving her $607 in taxes, $20K by 32% this year. Her effective after-tax cost is $13,600, $26 and 4Ks.
Okay.
If she waits until next year, option B, She still saves $6,400 in tax, but the saving is delayed. The present value of that $6,400 tax saving next year is only $5,818 today. So her effective after-tax cost, in today's dollars, is $14,182. 20K, $5,818.
So buying this year is cheaper after tax by about $580.
Correct. Accelerating the deduction gets you the tax savings sooner, making it more valuable.
Makes sense. Now let's throw in that changing tax rate again. What if Jill's rate goes up next year from 32% to 35%? Does she still buy the equipment now?
Good question. Let's check. Buy this year, option A, still $6,400 tax savings at 32%. Buy next year, option B. The deduction saves $7,000 in tax, 20K by 35%, because the rate is higher.
Ah, so waiting gets a bigger tax saving number?
It does. But again, time value. What's the present value of that $7,000 saving next year? Discounting at 10%, it's $6,363 today.
So $6,400 saving today versus a $6,363 present value saving if she waits.
Right. Accelerating the deduction is still slightly better by $37. Even though the tax rate is higher next year, getting the smaller saving now is worth slightly more.
Fascinating. It really highlights how you need to consider both the timing and the potential rate changes. It's not always obvious.
Not at all.
Yeah.
Facts and circumstances are key. You have to look at your specific situation.
Okay, let's move on to something that sounds, well, scary. The alternative minimum tax, or AMT. What exactly is this thing, and why does it even exist? Is it something most people need to worry about?
Yeah, AMT definitely has a reputation. It was originally put in place way back when because Congress noticed some very high-income taxpayers were using so many deductions and tax breaks that they were paying little or no income tax.
Ah, the fairness argument.
Exactly. The AMT is basically a parallel tax system. If you might be subject to it, you have to calculate your tax liability twice, once under the regular rules and once under the AMT rules. You then pay whichever amount is higher.
A parallel system. That sounds complicated.
It can be. The goal of the AMT is to calculate something called Alternative Minimum Taxable Income, or AMTI. Think of AMTI as trying to measure your economic income more broadly than regular taxable income does, by adding back certain tax breaks.
Adding back tax breaks. Which ones?
There are two main categories: adjustments and tax preferences. Adjustments can sometimes increase or decrease AMTI compared to regular taxable income, but many common ones only increase it for individuals.
Like what? What are the big ones people run into?
Probably the biggest one for many people is state and local taxes, the SALT deduction. For regular tax, you can deduct up to $10,000. For AMT, that deduction is added back entirely.
Ouch. So your $10,000 SALT deduction disappears for AMT.
Poof, gone for the AMT calculation.
Right.
Another big one we already mentioned is exercising incentive stock options, ISOs, that bargain element at exercise, added back for AMT.
Right.
Other adjustments might involve differences in how depreciation is calculated, certain losses, long-term contracts. And if you take the standard deduction for regular tax, that gets added back too. You don't get a standard deduction for AMT.
Okay, so adjustments add back things you deducted for regular tax. What about preferences?
Tax preference items always increase AMTI. They represent specific tax benefits that the AMT system just doesn't allow.
Always add backs. Examples.
A common one for individuals is tax-exempt interest from certain private activity bonds. These are municipal bonds issued to finance specific private projects, like stadiums or airports. The interest is tax-free for regular tax, but it gets added back for AMT.
Not all muni bond interest, just private activity bonds.
Correct. Interest from regular government purpose bonds is generally okay for AMT too. Another preference might be related to certain depletion deductions for oil and gas or some old depreciation methods.
Okay, let's quickly see how this adds up for Janet.
Okay, Janet, let's say her regular taxable income is $60,000. She itemized and had $9,200 in state and local tax deductions. That's an AMT adjustment. She also received $1,300 in interest from private activity bonds. That's an AMT preference.
So start with $60,000.
Right. Add back the $9,200 SALT adjustment. Add back the $1,300 private activity bond interest preference. Her alternative minimum taxable income, AMTI, becomes $70,500, $60K plus $9 plus $1 3K.
So her income base for AMT is significantly higher. Whether she pays AMT depends on the AMT exemption and tax rates.
Exactly. But you can see how those add-backs work to broaden the income base.
Definitely. Okay, another one that surprises parents. The kiddie tax. What's this all about? Is it really a tax on kids?
Not exactly a tax on kids, but it affects how some of their income is taxed. The kiddie tax is designed specifically to stop parents from shifting their own investment income to their children just to take advantage of the child's lower tax bracket.
Ah, trying to game the system by putting assets in a kid's name.
Precisely. So it applies to dependent children who are under 18 or who are age 18 to 23 and are full-time students and don't provide more than half of their own support.
Okay, applies to most dependent kids and young adult students. How does it work?
The core idea is that the child's net unearned income above a certain threshold gets taxed at the parent's marginal tax rate, not the child's rate.
Net unearned income. What's that?
Unearned income is basically investment income. Things like interest, dividends, capital gains, rents, royalties. It's not income from a job the child worked.
Okay, so their summer job earnings are fine.
Yes, earned income is taxed at the child's rate. It's the investment income we're focused on.
So how much gets taxed at the parent's rate?
For 2023, here's the breakdown. The child's first $1,250 of unearned income is covered by their standard deduction, so it's tax-free.
Okay, first $1,250 free.
The next $1,250 of unearned income is taxed at the child's own, usually lower tax rate.
Okay, next, $1,250 at child's rate. That's $2,500 total so far.
Right. Any unearned income over that $2,500 threshold is then taxed at the parent's highest marginal tax rate.
Ah, so that's the kiddie tax kicking in. Above $2,500 of investment income, it's taxed like it was the parent's income.
Exactly. There's also an option for parents. If the child's unearned income is only interest and dividends and falls within a certain range, between $1,250 and $12,500 for 2023, they can elect to just include that income directly on their own tax return instead of filing a separate return for the child. It can be simpler sometimes.
Let's see how this works for Max. Make it real.
Okay, Max is 15. He has $5,000 in corporate bond interest income. That's his only income. Max himself is in the 10% tax bracket. His parents in the 22% bracket.
Okay. $5,000 interest. How's it taxed?
First, his adjusted gross income, AGI, is $5,000. He gets a standard deduction of $12,050. So his taxable income is $3,750, $5K,
Right.
Now, how is that $3,750 taxed? Remember the thresholds. The first $1,250 of his unearned income is taxed at his rate, 10%. That's $125 taxed, $1,250 by 10%.
Okay.
The unearned income over $2,500 is taxed at the parent's rate. His total unearned income was $5,000. So the amount over $2,500 is $2,500. $5,000, $2,500.
Right.
That $2,500 gets taxed at his parents' 22% rate.
Yeah.
Plus the $550 taxed at parents' rate, which equals $675.
Got it. So if there were no kiddie tax, his $3,750 taxable income might have all been taxed at his 10% rate, $375, but because of the kiddie tax, his bill is $675.
Exactly. It prevents that significant tax saving from shifting investment income.
Okay, really good to know for parents with investments for their kids. Let's switch now to strategies that can actively put more money in your pocket. Things like special accounts and making smart choices about deductions. These aren't just about paying medical bills, right? There's more to it.
Absolutely. Two really powerful tools here are flexible spending accounts, FSAs, and health savings accounts, HSAs. People often get them confused, but they have key differences and huge tax advantages.
Okay, FSA versus HSA. Let's start with FSAs. What's the deal there?
Okay, flexible spending accounts, FSAs, these are employer-sponsored plans. They let employees set aside money on a pre-tax basis to pay for qualified medical expenses or in a separate FSA for qualified dependent care expenses.
Free tax, that's the key.
It's a huge key. You
Yeah.
fund it through voluntary salary reductions for a health FSA. The max was $3,050 in 2023. That money comes out before federal income tax and employment taxes, Social Security, Medicare are calculated, so you save on multiple taxes.
Nice. And then when you spend it.
When you use the money for qualified medical or dependent care expenses, the reimbursements are tax-free. So tax-free in, tax-free out for qualified spending.
Sounds great. What's the catch? I feel like there's always a catch.
The big catch with FSAs is the use it or lose it rule. Generally, you have to spend the money you put into the FSA within the plan year. If you don't spend it, you forfeit it back to the employer.
Ouch. Forfeit your own money.
Yeah. Now, employers can offer a little flexibility. They might give you a grace period of 2.5 months into the next year to spend the money, or they might let you carry over a certain amount, up to $610 for 2023, to the next plan year. But you can't have both.
Okay, so FSAs are really for predictable current year expenses. Need to estimate carefully.
Exactly. Good for things you know you'll spend, like daycare or regular co-pays and prescriptions.
Okay, now HSAs. Health savings accounts. You said these are even more powerful. How?
HSAs are different beasts and, yeah, arguably much more powerful, especially for long-term planning. Think of an HSA as like a triple tax-advantaged investment account, specifically for healthcare.
Triple tax advantage. What does that mean?
It means, 1. Contributions are pre-tax or tax-deductible, lowering your current income tax. 2. The money in the account grows tax-deferred over time, just like an IRA or 401k. 3. Withdrawals are completely tax-free if used for qualified medical expenses now or anytime in the future.
Tax-free in, tax-free growth, tax-free out for medical. That sounds amazing.
It really is. And here's the biggest difference from an FSA. HSA funds are yours. They roll over year after year. There's no use it or lose it. The account is portable. You take it with you if you change jobs.
Wow. So it's not just for current expenses, it's a long-term savings vehicle.
Exactly. Many people use it as a retirement savings booster, specifically for future healthcare costs, which can be huge in retirement.
Okay, who can get an HSA? Is there a catch here too?
The main requirement is that you must be covered by a high-deductible health plan, an HDHP.
High deductible plan. Okay.
Right. For 2023, that meant the plan had to have a minimum annual deductible of $1,500 for self-only coverage or $3,000 for family coverage. There are also limits on the maximum out-of-pocket expenses under the plan.
So you need a specific type of insurance. How much can you put in?
For 2023, the maximum contribution was $3,850 for self-only HDHP coverage and $7,750 for family coverage. Plus, if you're age 55 or older, you can add an extra $1,000 catch-up contribution.
Okay. And withdrawals. Always tax-free.
Tax-free if used for qualified medical expenses. If you pull money out for non-medical reasons before age 65, you pay regular income tax on it, PLUS, a hefty 20% penalty.
Ouch, 20% penalty. Avoid that.
Definitely. But here's where it gets really interesting for retirement planning. After you turn 65, if you take money out for non-medical expenses, you still pay regular income tax on it, just like a traditional IRA and 401k withdrawal. But that 20% penalty disappears.
Ah, so after 65, it acts like a regular retirement account for non-medical spending.
Essentially, yes. But withdrawals for qualified medical expenses remain completely tax-free forever. And qualified medical expenses after 65 gets even better. You can use HSA funds tax-free to pay Medicare Part B and Part D premiums, and even premiums for qualified long-term care insurance.
That's incredible. So an HSA can effectively become a super IRA just for retirement healthcare costs, paying for things like Medicare premiums totally tax-free. Let's see that with Pat and Roger.
It's a fantastic strategy. Okay, Pat and Roger Martin. Married, ages 65 and 66, healthy. Their main healthcare costs are $4,000 a year for Medicare premiums, Parts B and D, and $5,000 for long-term care insurance premiums. That's $9,000 total. They usually just take the standard deduction.
Yep.
If they have funds built up in an HSA from their working years, they can now withdraw $9,000 from the HSA to pay these premiums. Because these are qualified medical expenses, specifically allowed after 65, that entire $9,000 distribution is tax-free.
So what's the savings?
If they're in, say, the 22% marginal tax bracket, paying those $9,000 expenses with tax-free HSA dollars instead of after-tax dollars saves them $1,980 in taxes. $9,000 by 22%. That's nearly $2,000 extra spendable income each year, just by using the HSA strategically in retirement.
That is a powerful tool. Okay, next big decision point for many taxpayers. Itemized deductions versus the standard deduction. How do you decide? And are there clever ways to maximize this?
This is a fundamental choice on your tax return. And the decision rule is actually very simple. You choose whichever's higher. You add up all your allowable itemized deductions. If that total is more than the standard deduction amount for your filing status, you itemize. If it's less, you take the standard deduction.
Okay, higher is better. What are the standard deduction amounts? They change, right?
They do. They adjust for inflation.
Yeah.
For 2023, the basic standard deduction was $13,850 for single filers, $20,800 for head household, and $27,700 for married filing jointly. $13,850 also for married filing separately.
And you mentioned something about extra amounts for age or blindness.
Yes. If you are age 65 or older, or are legally blind, you get an additional amount added to your standard deduction. For 2023, if you were unmarried and 65 or blind, you added $1,850. If you're unmarried and both 65 and blind, you added twice that, $3,700.
Wow.
For married couples, the additional amount was $1,500 per qualifying spouse per condition, 65 plus or blind. So if both spouses were 65, they'd add $3,000 total to their standard deduction. This can make the standard deduction much harder to beat for older taxpayers.
Definitely boosts the standard deduction. So what are the common things people can itemize if they're trying to beat that
The
number?
big categories include medical expenses, but only the amount that exceeds 7.5% of your adjusted gross income, AGI. State and local taxes, SALT, including income or sales tax and property taxes, but capped at $10,000 per household per year.
That $10K SALT cap is a big hurdle for itemizing now.
It really is for many people. Other big ones are home mortgage interest on acquisition debt, up to certain limits, investment interest expense, up to your net investment income, and charitable contributions, subject to AGI limits, usually up to 60% for cash gifts to public charities. Also, certain casualty and theft losses in federally declared disaster areas.
So who is most likely to benefit from itemizing these days, given the higher standard deductions and SALT cap?
Typically, people who make large charitable contributions, have very high uninsured medical expenses, pay significant mortgage interest, especially on larger or newer loans, maybe substantial investment interest, or live in states with low or no income tax but high property taxes, those still subject to the $10 K cap.
Okay. Now, you mentioned a clever strategy earlier, bunching. How does that work for deductions?
Bunching. This is a great strategy, especially if your typical itemized deductions are just below your standard deduction amount each year.
So you normally just miss out on itemizing.
Exactly. With bunching, you intentionally try to concentrate or bunch controllable itemized deductions into 1 year, pushing your total itemized deductions over the standard deduction threshold for that year. Then, in the next year, or years, you take the standard deduction.
What kind of deductions can you bunch?
Charitable contributions are the easiest and most common one to bunch. Instead of giving, say, $5,000 every year, you might give $10,000 in 1 year and zero the next. You could also potentially time property tax payments if allowed, or maybe schedule elective medical procedures.
So you get to itemize in the bunching year and take the standard deduction in the off year. Clever. Let's see how Elizabeth uses this.
Perfect example. Elizabeth Roberts, single, age 64 in year 1. Yep. Her recurring itemized deductions are $7,500 in SALT, kept at $10K anyway, $3,000 in mortgage interest, and she usually gives $2,500 to her church. Total, $13,000.
Okay, $13,000. Her standard deduction in year 1, age 64, is $13,850.
Right. So if she gives $2,500 in year 1, her $13,000 is less than $13,850. She takes a standard deduction. In year 2, she turns 65. Her standard deduction jumps to $15,700, $13,850 plus $9,850 age add-on. If she gives another $2,500, her $13,000 is way less than $15,700. She takes a standard deduction again.
So standard deduction both years if she gives annually.
Correct. Now let's try bunching. Elizabeth decides to make both years' contributions the full $5,000 in year 1.
Okay, 5K charity in year 1.
So in year 1, her itemized deductions are $7,500 SALT, plus $3,000 mortgage interest, plus $5,500 per contribution.
$15,500. That's more than her year 1 standard deduction of $13,850.
Exactly, by $16,750. So in year 1, she itemizes and gets a $15,500 deduction.
Awesome.
Remember, she's 65 now, so her standard deduction is $15,700.
$10,500 is less than $15,700. So she takes the standard deduction in year 2.
Right. Look at the result over 2 years. By bunching her $5,000 contribution into year 1, she got a total deduction of $15,500, itemized year 1, plus $15,700, standard year 2, $31,200. If she gave annually, she'd get $13,850 plus $15,700 equals $29,550.
Wow. She increased her total deductions by $1,650 over 2 years just by timing that donation. That's a real aha moment.
It absolutely is. Bunching can be a very effective way to maximize deductions if you're near the standard deduction threshold.
Okay, last big topic before we put it all together.
Obviously.
Nobody likes penalties. How do you avoid underpayment penalties, especially if your income isn't steady, like freelancers or business owners?
Yeah, underpayment penalties are definitely something to avoid. The basic rule is if you expect to owe $1,000 or more in tax when you file your return, the IRS wants you to pay tax throughout the year as you earn the income, not just all at the end.
Pay-as-you-go system.
Exactly. Yeah. This applies to income tax, self-employment tax, etc. If you don't pay enough through withholding from a job or through making quarterly estimated tax payments, you can get hit with an underpayment penalty, even if you get a refund overall.
Quarterly payments. When are those due?
Typically, April 15th, June 15th, September 15th, and January 15th of the next year. You estimate your income and tax for the year and pay in roughly equal installments.
And if you don't pay enough, how bad is the penalty?
The penalty is basically like interest on the amount you underpaid for the period you underpaid it. The rate changes. It's tied to market interest rates.
Okay, how do we avoid it? That's key.
Right. There are safe harbors. You generally won't owe an underpayment penalty if
Well, sure.
your total tax due when you file is less than $1,000.
Okay, small balance is fine.
Or two, you paid, through withholding and timely estimated payments, at least the lesser of two amounts. A, 90% of the tax shown on your current year's tax return, ORB, on 100% of the tax shown on your prior year's tax return.
Ah, the 90% current or 100% prior year rule. That sounds important.
It's crucial. That 100% of prior year tax is often the easiest target, especially if your income is stable or increasing. Just pay what you paid last year, and you're usually safe.
Usually. Is there a catch to the 100% rule?
Yes, one important catch. If your adjusted growth income, AGI, in the prior year was over $150,000, $75,000 married filing separately, then that 100% threshold becomes 110%.
Okay, so higher income folks need to pay 110% of last year's tax to use that safe harbor.
Correct. Also, the IRS might waive the penalty in certain situations, like a casualty, disaster, unusual circumstances, or if you became disabled or retired after age 62 during the year.
Good to know there's some leeway. Let's run the numbers for Sarah, the orchard owner.
Okay, Sarah Wilson. She made timely estimated payments totaling $23,500 during the year. When she filed her return, her total tax liability for the current year was $25,000. She owed an additional $1,500 with her return. Does she owe a penalty?
Let's check the safe harbors. She owed more than $1,000, so that doesn't apply. Did she pay 90% of the current year tax?
Her current year tax is $25,000. 90% of that is $22,500.
$25,000 by 90 cents.
And she paid $23,500 through estimates.
Right. Since the $23,500 she paid is more than the required $22,500, 90% of current year tax, she meets that safe harbor.
So no penalty for Sarah, even though she still owed money when she filed.
Exactly. She paid enough throughout the year to avoid the penalty. That's the goal.
Perfect. Okay, we have covered a ton of ground. Stock options, imputed interest, foreign income, timing, AMT, kiddie tax, FSAs, HSAs, deductions, penalties. Wow. How do we bring all these powerful concepts together for effective year-end tax planning? Because that's when you can really make a difference, right?
Exactly. Year-end planning is where you look at everything we've discussed and see what levers you can still pull before December 31st to optimize your tax situation for the current year.
It's not static, though, is it?
Not at all. It's super dynamic. Tax laws might change, but more importantly, your life changes. Did your filing status change? Did you have a kid? Buy a house, change jobs, start paying tuition. All these things create potential planning opportunities. So it's about applying these strategies to your current situation.
Precisely. It comes back to timing income and expenses where possible. Can you defer income? Can you accelerate deductions? Can you harvest capital losses to offset gains? Can you maximize contributions to tax-advantaged accounts like HSAs or 401ks? Can you bunch deductions? It's your last chance to make moves that affect this year's tax bill.
Okay, this feels like the final exam for our deep dive. Let's look at Rob Johnson's comprehensive situation. He's got a few things going on. Let's walk through it step by step.
Let's do it. Rob Johnson. 48 years old, single, makes a $180,000 salary. His regular itemized deductions, SALT, mortgage interest, total $13,750. He's had $32,000 withheld from his paycheck so far. His tax last year was $31,516.
Okay, what's he considering?
He's thinking about selling some incentive stock option, IS stock, that he acquired 3 years ago. He expects a $20,000 long-term capital gain from this sale.
Okay, capital gain income coming in.
Right. He's worried this extra gain might push him into underpayment penalties. So he wants to know if there are strategies to offset the potential extra tax and avoid penalties. He's considering making a $5,000 charitable contribution and also maybe enrolling in his employer's high-deductible health plan, HDHP, and maxing out an HSA contribution.
Okay, lots of moving parts. What are the recommendations? How do we apply what we learned?
Okay, let's break it down. 1, selling the ISO stock. He's held it for 3 years. That easily meets the 2-1 rule. 2 years from grant, 1 year from exercise. So yes, that $20,000 gain will be taxed at favorable long-term capital gains rates. Good move from that perspective, just need to manage the tax impact.
Okay, secure the capital gain treatment. Good.
2, enroll in the HDHP HSA. This is a great move. If he enrolls, he can contribute the maximum for an individual HSA for 2023, which is $3,850. This contribution is an above-the-line deduction, meaning it reduces his adjusted gross income directly. Powerful tax reduction.
Right, pre-tax contribution. Excellent.
3, itemized deductions. His base itemized deductions are $13,750. If he makes that $5,000 charitable gift, his total itemized deductions become $18,750, $13,750 plus $5,000. His standard deduction as a single filer is $13,850. Since $18,750 is greater than $13,850, he should definitely itemize to get the bigger deduction. The charitable gift makes itemizing worthwhile.
Okay, so the recommendations are sell the stock, max the HSA, make the donation, and itemize. Let's see the numbers. How does this change his tax picture compared to doing nothing extra?
Let's compare.
Yeah.
$180,000 salary plus $20,000 LTCG. AGI is $180,000. LTCG doesn't affect the AGI calc for this purpose. He takes the standard deduction, $13,083.50. Tax on that is $33,276. Tax on the 20K LTCG at 15% is $3,000. Total tax to $36,276.
Okay, $36,276 tax without the planning moves.
After recommendations. Salary, $180,000. HSA contribution, $3,850. Reduces his AGI to $176,150. Now he itemizes. $18,750 deduction. His ordinary taxable income is $157,400. $176,150 AGI, $18,750 itemized. Tax on the 20K LTCG still $3,000. Total tax equals $34,176.
So total tax went from $36,276 down to $34,176. That's a saving of $2,100.
Exactly. $200 saved just by making those year-end moves with the HSA and the charitable gift.
That's significant. Now, what about his original worry, the underpayment penalty? Did this planning help him avoid it?
Let's check the safe harbors for Rob. His AGI is over $150K, so he needs to pay the lesser of 90% of his current year tax or 110% of his prior year tax.
Okay.
110% of his prior year tax, $31,550, is $34,758. That's his target payment amount.
Correct. And how much has he had withheld?
$32,000.
$30,000 withheld is more than the required $30,758.
Bingo. Therefore, Rob avoids the underpayment penalty by implementing these planning strategies. His existing withholding is enough to meet the safe harbor after accounting for the tax impact of the gain and the savings from the deductions.
That's fantastic. What would have happened if he hadn't done the planning, just sold the stock?
Good question. Without the planning, his current year tax was $36,276. 90% of that is $32,648. His withholding was only $32,000.
Uh-oh. Withholding less than 90% of the current tax?
Right. He likely would have faced an underpayment penalty on the $648 shortfall. $32,648 required $32,000 paid.
So the planning not only saved him $2,100 in tax, but also likely saved him from an underpayment penalty. That really shows the power of putting it all together.
It absolutely does. Proactive planning makes a huge difference.
Wow, what a journey. Seriously. From the nitty-gritty of stock options, ISOs versus NSOs, that 83B election, all the way to timing deductions and bunching, HSAs. We have really unpacked a ton of incredibly valuable stuff today. I feel like my financial decoder ring just got a major upgrade.
It's fascinating, isn't it, how these different pieces connect? And how decisions that might seem small on their own, like when you make that charity donation or choosing an HTHP to unlock an HSA, or just understanding how your bonus is taxed, can add up to have a really significant impact on your bottom line.
It really drives home that being informed isn't just, about ticking boxes correctly on your tax return or avoiding mistakes. It's actually about actively optimizing your financial life. Knowing these rules lets you play the game smarter.
Yeah, it's about strategy. Understanding these nuances can genuinely increase your after-tax wealth, give you more control, and maybe even reduce some financial stress.
Absolutely. So this brings us to the end, and it raises a really important question for you listening right now. Given everything we've talked about today, what's maybe one area of your own financial planning, your own tax situation that you're going to take a deeper look at next?
Yeah, maybe it's finally digging into that equity compensation package you got.
Yeah.
Or perhaps it's looking at whether bunching deductions could work for you this year. Or maybe just understanding if an HSA makes sense. What's your next step?
Food for thought.
Yeah.
Until our next deep dive, keep learning, keep asking those questions, and definitely keep that curiosity fired up, because knowing these rules means you're not just, a taxpayer subject to the system. You're actually becoming a strategic financial planner for your own life. And that's pretty powerful.